Hi, in this video, we will discuss the accounting treatment when debentures are issued as collateral security. Let's note a few important points. Loans taken are secured by a mortgage of the assets known as prime or principal security. Now, collateral security means security given to the lender over and above the prime or the principal security. That is, apart from the prime or the principal security, where any other security is given, then it is called collateral security. Collateral security can be realized by the lender only when both these conditions are fulfilled. One, the borrower must default in the payment of interest and or repayment of principal amount, and the prime or principal security should fail to meet the loan liability. So only when both these conditions are fulfilled, the lender can exercise his or her right on the collateral security. Debentures are normally issued as collateral security when the borrower is not able to mortgage an asset as collateral security. When the loan is paid back, the debentures which are issued as collateral security are also returned to the company. The holder of the debenture issued as collateral security is not entitled to the interest on the debentures issued as collateral security. However, if the borrower defaults in the payment, the lender may exercise his rights and claim the rights of a debenture holder and demand interest on debentures. Next, let's check out the disclosure in the balance sheet for debentures which are issued as collateral security. The debentures issued as collateral security is associated with the loan of the company. That is, the company could have borrowed a loan from, say, a bank and issued these debentures as collateral security. That is a security in addition to the prime or the principal security. Therefore, the debentures issued as collateral security by itself is not a liability of the company. The liability of the company is actually the loan borrowed. From the, let's say, a bank. So, it is just mentioned in the notes to accounts at the place where the loan borrowed and secured by the debentures is shown. So, the underlying principle is that information that the security is given for the borrowings or the loan borrowed has to be mentioned and disclosed. Let's go into the accounting treatment for debentures issued as collateral security. There are two methods to deal with this issue of debentures as collateral security. We will deal with this one by one. Let's begin with the first method. Now, in the first method, journal entry is not passed in the books of accounts at the time of the issue of debentures as collateral security. So, there will not be any journal entry passed for issue of debentures as collateral security in the books of accounts of the company. However, it will be disclosed by way of information below the loan borrowed. The loan borrowed itself may be a long-term borrowing or a short-term borrowing of the company depending on when the loan is to be repaid. Now let's assume that the loan which is borrowed from the bank is a long-term loan. So we will see the treatment for debentures issued as collateral security for a long-term loan borrowed from the bank. The example is A Limited borrows Rs 5 lakh from State Bank of India and issues 6,000 9% debentures of rupees 100 each as collateral security for the loan borrowed. The loan borrowed from SBI is repayable after a period of 5 years. So now we know that the loan is to be repaid only after a period of 5 years. So the loan borrowed by A Limited from State Bank of India amounting to rupees 5 lakh is a long-term loan. In the note to accounts, after leaving space for the balance sheet which we will prepare, under long-term borrowings we will write term loan from the bank. The amount is 5 lakh and we will just mention by way of a note secured by issue of 6,000 9% debentures of rupees 100 each as collateral security. And above we will show the balance sheet extract. Under the first part of the balance sheet, part 1, equity and liabilities, under non-current liabilities, under that A, long-term borrowings, against note 1 we will write 5 lakh, indicating that we have borrowed 5 lakh loan from State Bank of India, which is repayable after only 5 years. Now let's check out the treatment where debentures are issued as collateral security for a short-term loan from bank. In the same example, A Limited borrows rupees 5 lakh from State Bank of India and issues 6,000 9% debentures of rupees 100 each as collateral security for the loan borrowed. However, in this example, the loan borrowed from State Bank of India is repayable after a period of 10 months, making it a short-term borrowing since it's repayable within 12 months of the reporting date. So after leaving space for the balance sheet, we will prepare the notes to accounts. Against short-term borrowings, we will write the term loan from the bank 5 lakh rupees and mention that it's secured by issue of 6,000 9% debentures of rupees 100 each as collateral security. And we will continue to prepare the balance sheet extract on the top. In part 1, equity and liability part of balance sheet, we will write 1 current liabilities and show the 5 lakh rupees loan borrowed under short-term borrowings against note 1. So this is a treatment when the first method is followed, when we do not pass any journal entry for the issue of debentures as collateral security. Let's move on to the second method. Now in this method, the debentures issued as collateral security are recorded in the books of accounts by means of the following journal entry. The journal entry is debenture suspense account debit 6 lakh rupees to percentage debentures account 6 lakh rupees. The narration 6,000 9% debentures of rupees 100 each issued as collateral security for the loan borrowed. So in this method, the difference between the first method is that we will record a journal entry for the issue of debentures as collateral security. Please remember, in this method, once the loan amount is repaid, the above entry that we just passed has to be cancelled by means of a reverse entry. And the reverse entry will be percentage debentures account debit to debenture suspense account. So we need to pass this entry after the repayment of the loan to cancel the entry which has already been passed. Let's check out the treatment in balance sheet for debentures issued as collateral security, assuming it's a long-term loan from the bank. So in our example sum, A Limited borrows rupees 5 lakh from State Bank of India and issues 6,000 9% debentures of rupees 100 each as collateral security for the loan which has been borrowed. Now the loan borrowed from SBI is repayable only after a period of 5 years. So the loan is a long-term borrowing. Now in our note to accounts, which we will prepare after leaving space for the balance sheet extract, we will write 1 long-term borrowings. The term loan borrowed from bank is rupees 5 lakh. The way we depict the 6 lakh rupees of 9% debentures issued as collateral security is like this. Below the term loan from bank, we will write 6,000, 9% debentures of rupees 100 each issued as collateral security. In the inner column, we will write 6 lakh rupees and less debenture suspense. Again, a minus 6 lakh rupees, taking the amount to the outer column as nil, and the final amount of the long-term borrowing is 5 lakh rupees. And this amount will be depicted in the balance sheet extract as in the part 1 equity and liabilities, 1 non-current liabilities, A long-term borrowings against note 1 rupees 5 lakh. Now the treatment is the same in case it's a short-term loan from bank. We will show it under short-term borrowings over here. The rest of the note to accounts being the same. And in the balance sheet extract, we will write 1 current liability and under that A short-term borrowing, rupees 5 lakh. So that is the only change. Please remember, in both the two methods which we just discussed, the following journal entry has to be passed for the borrowing of the loan from the bank. This is in the books of the company A Limited, which borrows rupees 5 lakh from State Bank of India. The journal entry for the borrowing of loan from SBI is bank account debit 5 lakh rupees to bank loan account 5 lakh rupees. So this entry has to be passed in both the first method and the second method. And in the second method, an additional journal entry has to be passed for the issue of debentures as collateral security, being debenture suspense account debit to percentage debentures account. An important point to note, now in the balance sheet, the debentures which are issued as collateral security must be distinguished from the other debentures, the usual debentures against which a borrowing is made. Such debentures and debentures issued as collateral security, both must be shown separately. We should not mix the two up. What happens in case of non-payment of loan and the prime security is not sufficient to meet the default amount? Then the liability will arise and the lender invokes his right vested in the collateral security. For this, the journal entry, we will debit loan account with the principal amount of the loan plus any interest which is already outstanding on the loan. We will debit outstanding interest account with the amount of interest for the period between the date of default of the loan to the date of invoking the security by the lender, and we will credit to percentage debentures account for the total of the amount of default. Narration: for lender invoking his right in the collateral security on default of loan payment and or interest amount. So in this video, we learned the journal entries as well as a balance sheet which has to be prepared for issue of debentures as collateral security, both in the first method as well as in the second method. Any method can be followed by the student in case the question does not specify which method has to be followed. In the upcoming video, we will solve 1 or 2 example sums to understand this concept better.